Hi everyone, welcome to Chapter 4. Now we're going to be focusing on long-term financial planning and growth of a company. So some key concepts and skills that you will leave this chapter with is doing financial planning using what we call the percentage of sales method, where we help to determine the company's external financials needed to fund a firm's growth, the determinants of a firm's growth, and problems in planning for growth. So if you would have your book with you, that would be great, because I'm going to refer to it here and there so that things that aren't on our slides, I could point out to you. So we're going to be looking at what is financial planning, what are the financial planning models, some of them, the percentage of sales approach, external financing and growth, and the caveats regarding financial planning models. So the important thing to remember is that financial planning isn't a haphazard process. Okay, let's go to it. It's very important that we plan for the future. We want to know, what kind of projects do we want to take on? Okay, what type of investments in new assets? This will be determined by our capital budgeting decisions. What kind of stuff do we have to buy? How much financial leverage will there be? Well, so will be determined, and this will be determined by the capital structure decisions we make. How much cash are our shareholders expecting as a dividend? So these are our policies related to dividend payment. And what are our liquidity requirements? So this is determined by the net working capital decisions we make. What do we need to continue to operate on an ongoing basis? So we have to establish these things. Financial planning focuses on the big picture, the future, and some short-term stuff, but we're focusing more on the long-term in this chapter. So I love this saying, it's on the bottom, it's actually in the second to last paragraph, almost the last sentence, the 6 P's. Proper prior planning prevents poor performance. So when a company does perform poorly, it could be that they didn't properly plan. So it's very important that a company in the finance area takes on this responsibility. So what is financial planning? Okay, so this is our financial goals and how we're going to achieve them. Now, sometimes goals could be defined in terms of growth, but if we're going to define them that way, we want to focus on that stockholder, right? The growth of the market value of the stock is what's most important in our finance area. All the other things will lead to that if we focus on that. Now, our normal planning horizons, short run, usually less than 12 months. So that's our 1-year budget going out, or our 1-year planning going out. But then we have our long run decisions. And those are where we're looking 2 to even maybe 5 years out from today. What do we want to achieve? What kind of goals do we want to meet? What are the assets we're going to have to buy? How are we going to leverage? How are we going to pay for those things? We got to remember we got to pay shareholders some money. And how are we going to continue to operate on a day-to-day basis, making these kind of decisions? So they often call that 2 to 5 year period, it's on page 93, the planning horizon. And it really is our first dimension of planning, where we want to be. Now, as we're going and looking at this future and what kind of projects we want to take on, we usually will take an approach where all the projects are added together or aggregated. So here we're combining all of our capital budgeting decisions into one large project. So this is our second dimension. Remember what we said, it's a big picture. We're not saying, here's how we're going to fund this project, here's how we're going to fund that project. That's more in the short run. What we're looking at is aggregate in total. Also, so first, what do we want to achieve? And know that we're looking at the long term. Take all the projects that we want to do and aggregate them all together as one cost. And then we want to look at different scenarios. So we should take a look and prepare business plans for the best case scenario. The best case being you're going to you're going to achieve your goals based on the most optimistic assumptions. Worst case scenario, so now you're doing the complete opposite, and then the normal. So this is the most likely assumptions about the future of the company and also the economy, which is very important. We can't just make plans and predictions in a bubble, what we are going to do. We also have to look at the impact of the economy and different things like interest rates and taxes when we are making these plans. So some of the assumptions and scenarios have to make realistic assumptions about important variables, run the several scenarios. Again, where you could vary the assumptions by reasonable amounts, and then look at the worst case, normal case, and best case scenarios. This is all part of our process and trying to plan and figure out what do we need to buy, how much do we need to buy overall, how are we going to fund it, what about our working capital, and paying those dividends to shareholders, the impact that has on our whole financial plan and achieving our goals. So what is our role as financial planning? First thing is we need to look at the interaction of different elements of our plan. So we'll see this coming up, but this is where we define interactions of different items will help see what will happen when we make certain decisions. We want to explore all of our options. So we want to look at all different types of scenarios. We just don't want to pigeonhole ourselves into one. Hey, what if we went for external financing here? Or what if we sold more equity? What's going to be the impact of these different options? The most important thing is financial planning helps avoid surprises. So when you're doing that best case, worst case, normal scenarios and doing this planning, you're going to identify all your possible types of outcomes. And then you could plan accordingly. Geez, we didn't know that would happen if we did this. Ensure feasibility and internal consistency. So that's another role of financial planning. So it helps management determine if the goals they want to achieve can be accomplished, and if the various stated and unstated goals of the firm are consistent with one another. Are they conflicting? Are we bringing in the proper financial requirements? We want to keep our debt to equity ratio at a certain rate, but over here we're saying we're going to sell more stock. So we want to make sure everything's jiving together, and a financial plan will help do that. So that's what we're accomplishing when we create a financial plan in the long term, 2 to 5 years out. So again, we want to examine the interaction, these different decisions, how they interact with one another financially. We're going to look at all the options we have so that we can make a good decision. We do this to avoid surprises, and then we want to stay consistent internally and make sure everything's feasible. Now, how do we create a financial plan? Well, there's different ways, different models that you can use to create that 2 to 5 year plan. Remember, it's a big picture we're creating here. One way that we can do this is by using sales forecasts. So why do we use sales forecasts? Well, as you could see right there, cash flows, a lot of them depend directly on the level of sales. And I can tell you from my own experience, that was always my starting point with financial planning at any company I worked with at, to do that current budget and even looking out into a long-term budget, was using some type of sales growth rate. What percentage will our sales increase in 2 years from this year? And then based on these forecasts, you would then create pro forma financial statements. So you would now use these estimates to predict how your financial statements would look if these percentages came true. Then we would be able to determine our asset requirements. How much in additional assets will we need to purchase to meet these sales projections? Just like we said, if you need to buy something, you need the money. So how much are we going to borrow? How much are we going to sell in new equity? And then any kind of difference we call a plug variable. And that is where we're going to have to get more financing to make our balance sheet balance out. We do this all with keeping in mind and stating what kind of assumptions about the coming economic environment are we using. So I can tell you, way back when I was doing work with WNEP, we were doing some financial planning, and just on a very local level, just at our company. And one thing we needed to take into consideration was, at the time, it was 2000, 2001, the company was beginning to, or the economy was beginning to go into a recession. So we had to, when developing our sales growth rate, not pluck a number out of the sky, but look at some past history, look at where we were at in the market, in our sales market, and advertising, and then what impact the economy going into a recession would have. Now, normally when companies are operating in a recession, they start cutting expenses. They stop spending money. And one of the first things usually to be dropped from a company's expenses is advertising. So that would have a major impact on our sales at WNEP, because that's what we did. We sold advertising. So it's these kind of things you have to look at. You can't just, like I said, look at yourself in a little bubble. You have to realize the economy is beyond a major impact on your business and your growth and your predictions. So how will we do this? Let's take a very simple, and this is a little different than the amounts in your book, which I'm glad. Okay, so we're going to look at Gourmet Coffee. Gourmet Coffee has an income statement for the year ended December 31st, 2018. Keeping it simple, revenues less costs equals net income. And you might want to jot these numbers down on a piece of paper, because we're going to refer back to them. The balance sheet that results is assets are 1,000, debt is 400, equity is 600. Okay, so I'll give you a second there. Or you could even go stop the video and go look at this on your PowerPoint. Now, we're going to start doing some pro forma income statement. And remember, we got to define our assumptions. So here's some initial assumptions. This company thinks that their revenues will grow at 15%. They do then state that all items, everything on the income statement and balance sheet are directly tied to sales. And the current relationships are optimal. They're at 100%. They're all based on sales. Consequently, then, all other items will also grow at 15%. So we need to know these things. So you would be given them in a problem. Now, let's make pro forma income statements. How we do that is we say, okay, this year, revenues are $2,000. If revenues are going to grow by 15%, they will be $2,300 next year. So you can take 2,000 times 15%, will give you 300. 300 plus 2,000, 2,300, or multiply it by 100%, 0.15%. And that'll give you right to the number you need of 2,300. So we're just looking at this going into next year. Now, all revenues, okay, so all items are tied to sales. So if you go back to your income statement, I'm just going to go back here, right here. Do some vertical analysis on your income statement. Cost of goods sold, 1,600 divided by 2,000 is 80% of sales. Okay. That means net income is 20% of sales. Also, determine the amount assets are of sales. So 1,000 over revenue is 50%. The amount debt is of revenues. I know this is a little different approach, but that's what we're doing here. So $400 divided by 2,000 is 20%. And then 600 divided by 2,000 is 30%. So what we're doing here is converting our balance sheet and income statement into percentages based on each item is of total revenues or sales. Now, with that in mind, if revenues are now 2,300, then cost of goods sold is 80% of 2,300 or $1,840. Since net income on our original income statement is 20% of all revenues, 400 divided by 2,000, then with these assumptions, net income should be 20% of the new sales figure, 2,300 or $460. So that's how we create our pro forma income statement. Increase your revenues to what you project, and then based on percentages of sales from that old balance sheet, predict costs and net income. It says all items are tied directly to sales and the current relationships are all optimal. So that means all other items will also grow by 15%. So if you took 1,600 times 1.15, 1,840. So there's two approaches there. Do the same thing with your balance sheet. Oops. Well, let's take a look here. Case 1. Here's our next assumption. Dividends are the plug variable. So equity increases at 15%. Okay, so here's case 1. Assets, remember, were 1,000. They'll increase by 15% or 1.15, $1,150. Or assets are 50% of your new revenue, $1,150. So you could take either approach. Debt, same thing. it will also increase by 15%. So 460 was the, 400 was the original amount, times 1.15, $460. So if that's the case, equity has to be at 690. Now, it's currently at 600, so it would also have to increase by 15%. Okay, but what they're saying here is that's the plug value. So dividends, how much would be added in, or the dividend amount? Net income was 460 minus the 90. So we're seeing how this case one impacts our dividend payment. Equity was the plug, meaning assets are 1150, debt was 460, equity has to be 690. You have to think about the relationship of equity. How does equity increase? It increases for net income. Well, net income is at 460 under this scenario. Equity increased from 600 to 690. So the overall change should only be 90. So if 460 is how much it increased so far, and we only want it to increase 90, subtract 90, that means $370 must be paid as a dividend. Remember, equity, take your beginning balance, which would be the 600, plus net income for the pro forma period, which would be 460, minus equity for the ending pro forma period, which is 690. That gives us the amount that is dividends. Because when you subtract dividends, that will give you your new equity amount. So that's telling us how much we would have to pay in dividends. Take a look at case two. Now debt is going to be the plug figure. Okay, debt is going to be the plug figure. So how will we do this? Assets are still 1150, they increased by 1,000. Equity is 600 plus the new net income 460. Equity should be at 1,060. Assume no dividend payments. And that's the assumption in case two. We don't want to pay any dividends. What do we have to do to debt to make it balance out? Well, debt can only be at 90. At 90 to make, in case two, assets equal liabilities plus equity. So debt has to go from its current balance of 400 down to its pro forma balance of 90. So in this scenario, they must repay 310 in debt. So we're just looking at different scenarios to see what the impact of our decisions are in different cases. One, if we want to leave debt to increase 15% and make equity work out, or two, leave equity the same, just take equity plus net income for the period, no dividends, and see what the impact on it would be on us with regards to our debt. Would we pay more off or would we have to borrow more? So we're showing the impact of these projects on our financing, debt and equity. Now, in that scenario, and I like the one in your book as well. Make sure you take a good look through that. But in that scenario, everything was 15%. But some items don't vary. Some items vary directly with sales, while others do not, like cost of goods sold does. So on the income statement, so now we're getting, we're going to kick it up a notch. We're not going to assume everything increases by 15%. Costs may vary directly with sales. If this is the case, then your profit margin is constant. Okay, and that's what we're talking about here, sales minus cost of goods sold. is our profit margin. But depreciation and interest expense may not vary directly with sales because they're not based on sales. They're based on calculation. Depreciation is just a calculation we do, and interest is based on what we negotiate with the creditors. It's not based on our sales. So if this is the case, then your profit margin is not constant. And finally, dividends are a management decision and generally do not vary directly with sales. So this will influence the amount that actually does go back into the company for retained earnings. So when we're approaching our financial planning and using the percentage of sales approach, we have to keep these things in mind and identify these things that vary directly and indirectly, and then create assumptions for them. The balance sheet. Initially assume all assets, including fixed, vary directly with sales. Accounts payable also will normally vary directly with sales because it's usually buying in, off of our suppliers. However, notes payable in the current area, short-term debt and equity do not normally vary directly with sales because, again, these are on management decisions about capital structure. How much do we want to borrow? How much do we want to sell of equity? Another item, the change in retained earnings portion of equity will come from the dividend decision. So how much of the net income we retain in the company isn't based on sales, it's based on how much we pay out as equity. So it's very important that we keep these kind of items in mind when we go into our planning process. We can't just assume everything's based on sales. That was nice in our first scenario. So let's take a look at another company. This is Tasha's Toy Emporium, and you may want to jot these things down. I didn't print mine out, so. Okay, give me a second here. So we have sales of $5,000, costs are $3,500, our earnings before taxes are $1,500. They even took out interest. Then we have our taxes of $315 and net income. Of the net income, $474 are dividends, $711 are added to retained earnings. And then we get our percentages. So if you take $3,500 divided by sales, 70% of sales is for the costs. $1,500, our earnings before taxes divided by sales of $5,000 gives us a 30% ratio. And then taxes are 6.3% of sales, $315 divided by 5,000. And then finally, our net income is 23.7% of sales, or $1,185 divided by 5,000. Now, if you take the 474, okay, and divide that by 5,000, tell you what percent goes where. So 9.48% of that 23.7 is paid out as dividends, and 711 divided by 5,000. The other 14.22% of the 23.7 in net income is retained. Now, they give us some assumptions here. Assume sales will grow at 10%. And the dividend payout ratio, so how much do we pay out, is 40%. How do we get that? Well, say how much do we pay out as dividends? 474. How much is our actual net income? 1,185. So that's telling us the percentage of net income we're paying out. The other percentages I calculated was the percentage of sales dividends are and the percentage of sales that we add to retained earnings. But the dividend payout, dividends, actual dividends divided by net income, and you get 40%. So that is a calculation. And you can see that on page 99. Now, something else we need to keep in mind and calculate is what we call the retention ratio or plowback ratio. And how we get that is by taking 1 minus your dividend payout. So in this case, 1 minus 40% or 60% of net income is retained in the business. That is your pushback or plowback or retention ratio. Retained earnings, retention ratio, that's how much we keep. We're going to be using that in our calculations going forward. So you want to keep that in mind. You can also find that by taking the 711, that's add to retained earnings, divided by net income of 1185. It'll give you the same result. Okay, so after all of that, what do we end up with on a pro forma basis? Now, first of all, sales will grow by 10%. So if you take sales in 2018 of 5,000 times 1.1, 10%, 5,500. Now, take a different approach. It doesn't say all items are going to grow by 10%, okay? It says that's going to grow. So now we're going to take 5,500, the new sales amount, times the 70% to determine how much is cost. So we're going to base our projection, our pro forma, on those percentages we calculated in 2018's, and we based those percentages on 2018 sales. Well, now we're going to calculate the pro forma using those percentages based on our pro forma sales, our future sales. Same with earnings before taxes. Take the 5,500 in sales on the pro forma, multiply that by 30%, 1,650. Take the 5,500 times 0.063, 347. Or you can also take 1,650 times 21%. Because it's a flat tax, you're able to do that. Now remember, if you have ideas of what's going to be happening with taxes, I mean, you can't predict what Congress is going to do, but if you have some information that could help you with your prediction better, you use it. And then net income would be 5,500 in the pro forma sales times 0.237 or 23.7%, $1,303. Now, the dividend payout, remember, is 40%. So we're going to take 1,303 net income times 0.4. $521 of net income will be paid out as dividends. So if 40% is paid out as dividends, the other 60% or retention ratio is added to retained earnings. So take 1,303 times 0.6, because that's the only two things that could happen to net income. Pay them out as a dividend or put it back into the company in retained earnings, 782. Okay, so again, first, get your assumptions, 15% or 10% increase in sales. Take your starting income statement, make a pro forma income statement based on those assumptions. Dividend payout of 40%. Now we're going to go into Tasha's income statement. Now, this is her current income statement. So assets are current, cash is 500, accounts receivable is 2,000, inventory is 4,000. So this is at 2018. So the total is 6,500. Property, plant, and equipment is 5,000. Total assets 11,500. You can see the current liabilities, notes payable, long-term debt, common stock and additional paid-in capital, and retained earnings. Now, let's do a pro forma. How do we do that? You could see there at the next column is our percentage of sales. And what does it say? The next column are percentages. And these are percentage of sales, meaning we're going to take each asset divided by sales from 2018. So remember, the sales are 5,000. So 500 divided by 5,000 Cash is 10% of sales. Accounts receivables, 2,000 divided by 5,000, 40% of sales. Inventory, is 4,000 divided by the 5,000. So we're using all the 2018's numbers, and we're finding out what each asset is of sales. We're going to do that just for accounts payable. We don't do that for our notes payable, long-term debt, or our equity. We don't base it on sales. It's not part of sales. These assets are, or we're assuming they are. Remember we took a look back. We said, here's some things you need to look at because not everything's going to grow 15%. So now what are our numbers in the next column? Well, these are our pro forma balance sheet numbers. What does that mean? Okay, cash is 10% of sales. Well, if our new sales, let me just flip back here, are 5,500, we're going to multiply 5,500 times 0.1. So now our pro forma cash, 550. Accounts receivables, take the 5,500 in pro forma sales times 40%, 2,200. Inventory, again, for 5,500, take your new sales amount times that 80%. So we're telling you what your pro forma assets would be based on these sales, because the assumption here is that these assets are all based on sales or affected, directly related to sales. Property, plant, and equipment, they're 100%, so 5,500. So now we predicted how much in assets we're going to need if we want a 10% sales growth. And that's the $12,650. Accounts payable is the only liability that is based on sales. So we're going to take 5,500 times 0.18, 990. We're not going to change notes payable, long-term debt, we're going to keep those constant, and common stock and additional paid-in capital. The only item that will change is equity. In equity is retained earnings. Let's see how. So you can see retained earnings starts at 3,100. Remember how retained earnings changes. It increases for the addition to retained earnings. Oops. And that's how we get the 3,882. 3,100 where it began, plus the part of net income that's added to retained earnings, $782. So now if you're looking, go, oh, wait a second here. Okay, so assets are 12,650, right? Liabilities are a total of 6,490. Equities 4,760. Assets don't equal liabilities plus equity. And you're right, because we're trying to figure out how much additional external financing we need for these projects. And we kept our notes payable constant and our long-term debt and our common stock. We leave them constant because then we could see, geez, how much more do we need and what are we going to do? Borrow it or sell more stock? So now the firm needs to come up with additional $278 in debt or equity to make the balance sheet balance. So now you could choose a plug variable, meaning borrow more short-term, borrow more long-term, sell more common stock, or decrease your dividend payout, which will increase the amount in retained earnings. So now you saw how we actually predict, okay? And we based on assumptions, but this assumption was that sales increased by 10%. The assets were all directly related to sales, and the notes payable, long-term debt, and the common stock are not. And when that happens, Once we see what that growth does to the assets and the liabilities that do change, then we can help predict what we need in the future. And EFN is for external financing needed. Now, some more stuff. The analysis we just did assumed that we were using all of our assets at 100% capacity. Can't use them any more than we already do. Suppose that's not true. Suppose that the 2018's income statement sales, our company's only using 80% capacity of the assets for whatever reason. How much would we had in sales if we did operate at full capacity? That's our first calculation there. So if $5,000 in sales is at 80% capacity divided by 0.8, okay, then that means 100% capacity sales would have been $6,250. So estimated sales, the 5,500, if you take 5,500 divided by 6,250, shows we're still only operating at 88%. Now, if we're only operating at 88%, we shouldn't be buying more assets. We shouldn't be buying more fixed assets, long-term assets, those property, plant, and equipment. So let's take a look back. So even with keeping our sales at 5,500, we'll still need assets, current assets of 7,150. But you see that net property, plant, and equipment? No, we're not even operating at 100% with the new projected sales. So we're not going to need to purchase anymore. So now our total assets have decreased to $12,150. I'm going to go back to our balance sheet here. So now it's saying this number right in here should be 12,150. Our liabilities and equity are above that, 12,372. So what does that mean to us? Well, we could repay the excess on our short-term debt, our long-term debt. We may want to buy back some stock. We want to pay more in dividends, or we could just put it in our cash account, increase the cash account. The point here is showing you that when you have financial planning in place, it will help you make these predictions so you can see the impact of increase in sales. And you get very specific with your assumptions, like you could see here. Don't just assume you're operating at 100%. Check, make sure. See what you would have done if you were operating at the required amount. Because under the 100% assumption, you needed more money. But in reality, you don't. Okay, so those are the major components. I like this at the bottom of page 106. I want to talk about this and the growth rate. If you go to page 106 of your book, there is a table there that was created by for the company in the book. And I just want to go through the numbers. So this company, if it has zero sales growth, it's not going to require any more in assets. Okay, zero increase in assets. However, and this is from page 105, part of its net income is added to equity. So there's an increase in liabilities and equity, no increase in assets. So even if you write down assets equal liabilities plus equity, increase in equity, oh, no increase in assets is required. So what can we do? There's minus $44 less needed in external financing. Now, what would be the projected Debt to equity ratio. Remember, debt to equity, we take debt over equity. Okay. And if we have $44 less in external financing, so 250 minus 44, 206. Whoops. Let me just check something very quickly. Oops, I'm a little bit off there. So I am on page 106. Oh, there's my pro forma. External financing needed would be 47.2. Sorry about that, just bear with me. I didn't get a chance to look at these. I should have before I came on here. Just hold on, I'm gonna go off a second so I'm not wasting your time. Okay, I'm back. I think I got it figured out. Okay, so here's how you project the debt to equity ratio. So we're going to say, okay, what's my current owner's equity? 250. How much will I add to retained earnings? 44. So my equity will be at 294 under this first assumption. What is my total debt? 250. How much will it go up or down? It will go down 44 because I will need $44 less. So take your total debt under this assumption of 206 divided by total equity of 294. 70% is your debt to equity ratio. And that's how you would calculate each. So let's go to the next one on this table. 250 was your original starting place plus 46.2 in addition to equity. So your equity would be at 296.2. Your liability is also 250, but you would need 21.2 less, so you would pay that much off, we're assuming. Now take your new debt of 228.8 divided by 296.2. 77% would be your debt to equity ratio. So you can complete that with those numbers for each sales growth percentage. Now, this shows you, if we graph it on the top of page 107, your horizontal axis will be projected sales growth. So that's your very first column, 0, 5, 10, 15, 20, 25. The vertical axis will be assets, asset needs, and retained earnings. So that will be the amount of addition to retained earnings that will occur under each growth scenario. Okay, so starting at, I'm sorry, I should have told you where it says 44, at 0% growth, retained earnings goes up 44. At 5% growth, it's between 44 and 50 at 46.2. At 10%, it goes up to 48.4. At 15, you could see the line goes up to 50.6. Above 50, at 20%, where it says projected addition to retained earnings, that's the line we're on, 52.8. And then at 25%, it goes up to 55%, a little above that 50%. So if we draw a line, that's our line just to show how much retained earnings increases at each percentage. The increase in assets is the other more vertical line. At 0% sales growth, there's 0 in additional assets. But at 5, there's a 25 increase in asset. At 10, there's a 50. At 15, there's 25, and you could see those points on that line. When we cross those two lines, okay, we're showing you what happens. At 10%, there is no need for any type of external financing, basically. That is our optimum point if we want no external financing. If our growth is less than 10%, there'll be no need for external financing. As a matter of fact, we'll be able to pay some off. That's the point below the intersection. But if the percentage is above 10%, then there will be a need for external financing, additional debt or equity being sent out. So that's a great picture of that table. So you could really see the impact of those different, the projections have on your asset numbers and retained earnings numbers, and then overall, picture-wise, if you will need external financing. So I just wanted to go over that table with you and explain it, and hopefully that makes sense, and you can post questions about it on the discussion board. Now, at low growth levels, internal financing or retained earnings may exceed the required investments in assets. However, as your growth rate increases, internal financing will be not enough, and that's what we're seeing in that picture. So as our growth increases, we've got to go to places outside of the company or internal financing into debt or equity to attain those funds. So when we examine the relationship between growth and external financing required is a useful tool in our long-range planning, because we know as our growth rate increases, as depicted here by the table and the graph, we are going to have a need for external financing. So let's see. What is our internal growth rate? So this tells us how much the firm can grow assets just using retained earnings as our only source of financing. So we only want to finance our company from within using the earnings we kept in the company. Now, the internal growth rate assumes that the dividend payout ratio is always constant, so you're not changing it up. Using the information from Tassa's Toy Emporium, here's how we calculate internal growth rate. It is the return on assets ratio that you used in last chapter times your retention ratio that we talked about here, the percentage of net income we retain in retained earnings, times 1 minus your numerator, the ROA times B. So I'm going to flip on here, income statement. So let me go back. Sorry about that. There we go. So we need to calculate our return on equity, which they show us there. So let me go back over to our income statement. Oh, sorry about that. Just bear with me. I know I could have hit that other thing, right? I have us all over the place. Sorry about that. So one more, previous. Okay. Our current net income is $11.85. And our current assets are $11,500. So I will, bear with me while I do this. Okay. 1185 divided by 11,500. We already know our retention ratio is 60%. And you could go on back and take a look at that. So if we take our return on equity, which we calculate as 0.1030 times 0.6, divided by 1 minus, first calculate, 0.1030, oops. So your numerator, essentially, 0.1030 times 0.6 is 0.0618. Now subtract 1 from 0.618 and you get 93.82. So if you take 0.0618 divided by 0.9382, you get 6.6%. So that's how much growth they can have in their company without going for any external financing. And it's calculated by taking your return on your assets, which is net income divided by assets, times how much of the net income you retain in the business, divided by 1 minus that numerator calculation. The next growth rate is called the sustainable growth rate, and that tells us how much the firm can grow by using internally generated funds and issuing debt just to maintain the constant debt ratio they have now. So they're not increasing the amount of debt to equity. They're keeping it constant. So assumptions. The sustainable growth rate also assumes dividend payout ratio is constant, so you're not changing around the retention ratio or plowback. And there's no new external equity issue, but debt will increase with growth. Now, using Tasha's Toy Emporium, here's how we calculate it. This is a different focus. The return on equity times the retention rate or plowback over 1 minus that numerator. So again, your income is $11.85. So I'm going to go back. Now I'll just actually use the links, right? Oh, let's go to equity. There's your equity. 5,100 right there. And let me go back to, and then here's our income, 1185. So 1185 divided by the equity of 5,100, the return on equity, what the company makes for the investments the owner made, is 23.24%. The B is 0.4. Oh, no, it's not. Hold on. I probably read it wrong. Hold on a second. Let's go back to the last viewed, right? Nope, that's not what I wanted. Sorry, I'm all over the place. Let me go next. Go back to the income statement. Our income statement, dividend payout is 40%, but that's not what B is. In the sustainable growth, okay, I'm just making sure they didn't change it up on me here. It's still 2/3, right? So this is incorrect on this slide, of course. So this should be return on equity, which is 0.2324 times 0.6. The retention ratio is 0.6. So that number should be 0.2324 times 0.6, 0.13944 in the numerator, and then 1 minus 0.1399 will be your, 1 minus 0.13944 will be your denominator. So 0.13944 divided by 0.86056, 16.2%. 16.2%. I'm just going to look at this one more time. Yeah, that's a little jazzed up there on the, make sure I'm not telling you in the wrong direction here. Yeah, that should be 0.6 because the dividend payout is 0.4. So I'm sorry about that error there, but again, your calculation will be return on equity, which is correct, 23.24% or 0.2324 times 0.6. And that'll give you 0.13944. Then subtract that 0.13944 from 1, and that will give you 0.86056. Divide the 0.13944 from your first calculation into 0.86056 from the calculation we just did, and that should be 16.2%. 4%. So what is this saying? Assuming a constant growth ratio, debt ratio, constant debt ratio, and the dividend payout doesn't increase or decrease, this is the maximum amount of growth this company can afford to do to keep their debt ratio constant and not sell more equity. So I know it's kind of crazy there, but these are just some maximums we look at. How much can we grow before we have to go to any external financing? So that's our internal growth rate. The sustainable growth rate says, oh no, we could take more debt on, but we're going to maintain our debt to equity ratio at the same percentage. We don't want it to increase or decrease. So what's our maximum we can do before that would happen? Helps us in planning for the future. Now, what are our determinants of growth? Well, this is great on page 109. It takes us back to, remember, return on equity. Profit margin times total asset turnover times equity multiplier. So the first thing that is definitely going to determine growth is our profit margin. And the way you look at it is an increase in profit margin will increase the firm's ability to generate funds internally and also increase their sustainability growth. So we would be able to grow more from internal funds and maintain our debt ratio. Asset turnover. An increase in the firm's total asset turnover, the effect on sales is to increase it because you're increasing the amount of sales for each dollar in assets. This would decrease the firm's need to buy more assets, new assets, as sales grow. So if you don't have to buy new assets, your sustainability growth rate will increase. So your sales can increase without buying more sales and taking on more external financing that would disrupt your current debt to equity ratio. Financial leverage. So your financial policies, an increase in your debt to equity ratio increases the firm's financial leverage because you're borrowing more money. And because it makes additional financing available, it actually increases the sustainability growth rate, assuming you're okay with that debt to equity ratio increasing. And finally, dividend policy. The choice of how much to pay to shareholders versus reinvesting in the firm. So a decrease in the percentage of net income you pay out will increase your plowback. So that will increase the amount you're putting back into the company, and that will only increase your internally generated equity and sustainability growth. So based on, there's just a couple formulas and policies and the effect each of these will have on the amount you can grow from internal money or the maximum amount you can grow, maintaining a certain debt to equity ratio and internal money. Internal money being those monies you retain in the business from profit. So it is important to remember that we are working on accounting. Therefore, we must ask ourselves some important questions as we go through the planning process. How does our planning affect the timing and risk of our cash flows? Does the plan point out inconsistencies in our goals? And if we follow this plan, will we maximize owner's wealth? You know, if we're not maximizing owner's wealth by using only the company's money inside, so it goes beyond just this prediction. We've got to look at the big picture. What we're showing you is, or are, some of the tools used. Again, the percentage of sales approach starts with sales and makes some assumptions based on sales. We create a pro forma income statement and balance sheet to see what the overall impact will be on an external financing. External financing and growth are directly related. So as you increase growth, your external financing needs will increase as well. And we saw that from our graph on page 107. But we have two great formulas to help us determine what's the internal growth rate, what can we grow internally without using external funding, and then our sustainability growth rate. So we got to keep all these things in mind as we're going through this process. And these four great items that as they change, dividend policy, financial policy, total asset turnover, and our profit margin. As these items change, what is the impact on these internal growth and sustainability growth percentages? The final item here is a comprehensive problem. And we're just going to take a few minutes, and I suggest you turn it off right now and try this problem and then turn on when you come back. But I'm going to keep going. If XYZ is the following financial information for 2018, they have sales of 2 million, net income of 0.4, dividend of 0.1, current assets of 0.4, fixed assets of 3.6, current liabilities, long-term debt, common stock, and retained earnings. What is the sustainability growth rate? And then if 2019 sales are projected to be 2.5 million, what is the amount of external financing needed, assuming XYZ is operating at full capacity and profit margin and payout ratio remain constant? So I think that's the end. Yeah. So, but I'm going to end that, and then I'm going to share with you. Come on, you. Whoops. I'm going to stop sharing that. Okay, let me open up an Excel, and we'll take a quick look at this together so you could see one more example. And I'm going to share this with you. There we go. Okay, so you should now see an Excel spreadsheet, and we are going to take a look at how to compute the various items. What is the sustainable growth rate? So we know that is a formula, right? And it's, remember, we need to determine the return on equity, which is net income divided by shareholders' equity. Now net income here is 0.4 million divided by total stockholders' equity, which would be the common stock, 2 million, plus retained earnings of 0.8 million. So we would have 0.4 divided by 2.8. And that gives us 14.29%. So that is our return on equity. We also want to determine the payout ratio, which is our dividend amount, which, let's see, they tell us dividends are 0.1 million divided by our net income, which is 0.4, so 25%. Our retention ratio would then be 1 minus, our payout ratio of 25%, or 75%. So how do we calculate sustainable growth? Well, we take our ROE, our return. So sustainable growth is our formula, which will be ROE times B, which is your retention ratio, divided by 1 minus ROE times B. So if we put our numbers in there, 0.1429 times 0.75, which is our retention ratio, divided by 1 minus that answer. So let me make sure I get an answer. 1 minus 0.107175 is our denominator. So if we take that, oops, I could just do this. Hopefully we'll get an answer, and I'm getting 12%, and that should be a point there. So I get a percentage, there we go, 12%. So the maximum growth they can sustain without changing their debt to equity ratio is 12%. So that is their sustainable growth rate. Now, if 2019 sales are projected to be 2.4 million, what is the amount of external financing needed, assuming they're operating at full capacity, profit margin and payout ratio remain constant? So let's do a quick income statement here. So we have sales. What else do they give us here? And net income. Oh, that's nice. So sales minus costs gives us net income. Their current sales are 2 million. Their current net income is 0.4. So that means that their costs are 1.6. Their current profit margin would be the 0.4, right? Divided by 2, 20%. And then their current cost, just to percentage-wise, 1.6 divided by 2 would be 80%. Now, that's our percentages. What's our pro forma? Well, now sales will be 2.4 million. So let's take 2.4 times 80%. Cost would be 1.92. Net income could just be the difference there, or you could take 2.4 new sales times 20%. So it'd be 0.48 million. Now, let's go to our balance sheet. They tell us current assets are 0.4 million. Fixed assets are 3.6 million. So our total assets then are 4 million. I'm just going to make this little bit over here. I'll make our liabilities. So on the other side, I'm going to have current liabilities of 0.2 million, and then long term will be 1 million. Common stock is at 2 million, and then retained earnings is at 0.8. So let's add those up and make sure that they all jive out. Yep, 4 million and 4 million. So our total, liabilities and equity equal right now our total assets. So let's do this so that we give some distance between them. So that's where we stand at 2018. Just going to put those about above there. Okay. Now, if we take each of these as a percentage of sales, that's our first step. So 0.4 million divided by 2 million. Whoops. Current assets are 0.8% of sales. So this is a percentage of sales, and we're basing it on the 2018 sales. 3.6 divided by 2 million. You can see that's a lot. So they're 180% of sales. And then total assets, 4 divided by 2. That's not good. We don't want it to be a date, right? We want it to be a percentage, 200%. Let's do the same thing with liabilities. So we're going to percent of sales. And we're only going to do that for our current liabilities. We're going to assume that's the only accounts payable. Okay. So 0.2 divided by sales of 2,000, of 2 I mean, is 10%. Okay, so let's do some calculating. Let's take current pro forma sales of 2.4 times 80%. So our need for current assets will be at, that doesn't seem right. I think I did something wrong there, huh? Plus 0.4 divided by 2, 20%. I did, I'm sorry about that. So really that should be 2.4 times 20%. There we go. Now if we take 2.4 times 180%, our need in fixed assets will be at 4.32. Take our pro forma sales times 200%, 4.8 will be the total amount of assets that will be needed. The current liabilities will increase, take 2.4 times 10% to 0.24. Now assume long-term assets stay at 1, common stock stays at 2. Now retained earnings is going to change. Let's take a look at how retained earnings will change. It starts at a balance of 0.8. But for our pro forma period, we're going to add to it net income. Now, here's what you got to keep in mind. The new pro forma net income is 0.48. A portion of that is going to be paid out as a dividend. We need to find out what portion. So let's do the dividend payout rate. Now in the slide, it said the payout rate is going to stay constant. So we can calculate the payout rate as of 2018, which would be the 0.1 million that was paid out divided by 0.4. Or, and I think we already did that, was 25%. So 25% of net income is being paid out. So that means the retention that will be added to the amount of net income that will be added to retained earnings for our pro forma period will be 0.75. So of the 0.48 in net income for the pro forma period, 75% of it will be added to the balance in retained earnings. My calculator keeps going up. 0.48 times 0.75 or 0.36. So retained earnings is going to change for the pro forma period by 0.36. Oh gosh. There. Okay. So retained earnings is going to increase to 1.16. So let's see where we stand. What we're predicted in our pro forma time is that we will need to have a total of 4.8 million in assets. How much in liabilities and equity right now do we have to finance those? So I'm going to add up the pro forma current liabilities plus the long-term that didn't change, the common stock that didn't change, and the retained earnings that changed because of the net income that's retained in the business. So I'm getting 4.4 million. So we need to, total assets are 4.8. Total liabilities and equity right now, assuming no increase in common stock or long-term liabilities, 4.4. So the company will need external financing of $0.4 million. $0.4 million. And that's how you would determine that. So you would need to really start with that income statement, make a pro forma income statement, then take your current balance sheet using the percentage each asset is of sales, and assuming 100% operating capacity, you would then make a pro forma based on the percentage multiplied by the pro forma sales. What assets will be needed? Then only current liabilities you would pro forma out, increasing it or decreasing it based on your pro forma sales. Long-term remains constant, common stock remains constant, and retained earnings would change for the amount of net income that would be added or kept in the business of the net income for the pro forma time. Your assets and liabilities are not going to equal. Assets, liabilities, and equity will not equal after that. So the difference, since our assets are greater than our liabilities and equity, we will need additional financing. If assets were less, then we would be able to pay off some of our long-term debt or pay out more as a dividend because we would have excess in liabilities and equity than is needed. Okay, so that is how you should work through that problem. Now I'm going to end our presentation. If you have any kind of questions, I know this is getting kind of crazy with using balance sheets and the different kind of ratios and a different type of focus. What we're doing here, we're planning for the future and using these tools of planning to create a good plan that will help us reach our goal, which in corporate finance is to maximize the market value of the stock for the shareholder. Okay, so that ends our discussion.